These are the biggest red flags in your business financials. We're going to talk about why understanding these red flags early can actually save you from bigger problems down the road, how these red flags impact your confidence in making business decisions and investor confidence, and then also what you can do to start spotting these issues before they become critical. What is up? My name is Dylan. If you're not sure who I am, I'm one of the co-founders at our company STAXX, where we provide fractional CFO and accounting services to business owners, typically anywhere from 1 to 30, 40 million a year. In this video, we're going to go over some of the biggest red flags that we see inside of your guys' businesses. So as part of our sales process, we typically do an audit where we'll get access to the QuickBooks and do a deep dive in there. And I've brought Devon in on this video. She's the head of our CFO department, and she's the one that actually gets inside of these businesses' financials and pulls out everything that's wrong with them. So I'll let Devon introduce herself, and then we'll go over this document we made explaining some of these red flags that we often see.
Awesome. Yeah. Director of CFO Services here at STAXX. Been here, 8 months now. Time's flying. But undergrad finance, MBA accounting, master's in data analytics. Been doing this kind of scoping, auditing process for a few years now. I've been a fractional CFO for 6 years. Little stint with private equity and hedge fund work. But this is definitely my favorite part of the business, is going and seeing what's wrong, worming through the books. Because most people think that they have it together and they don't. It's nice to kind of bring some of those things to light, especially when they have a trusted accountant already. To offer a free service like this, it's like they have nothing to lose. And I love that whether they do business with us or not, we're sending them this roadmap of what they need to do to get their books together and get their business together and run their business by the numbers. And that's really what matters.
Yeah, 100%. And it's definitely, we do it just as much for us because, like you said, most people don't even understand how messed up their books are or how messed up their financials are because they're not sure what to be looking out for. So hopefully this video gives you a good idea of what you should look out for. So let's just jump right in here. Let me share my screen. So these are the biggest red flags in your business financials. We're going to talk about why understanding these red flags early can actually save you from bigger problems down the road, how these red flags impact your confidence in making business decisions and investor confidence, and then also what you can do to start spotting these issues before they become critical. So the first one that we see all the time is no cost of goods or cost of services broken out in the chart of accounts in the income statement, which essentially means that you're not able to see a true gross profit margin. Devon, why is this such a big deal?
So really your gross profit margin is just how efficient your people are, right? And how efficient you are at putting out your product or your service. So gross profit margin is going to be a big one, especially when it comes to benchmarking against other people in your industry. You want to be the most efficient. You want to have the highest number there. So sometimes when you're constantly reporting 100% gross profit margin month over month, and you're not seeing that and everything's kind of hitting your SG&A, what it does is it kind of muddies the waters, right? So you think that maybe the rent is the issue, whereas reality is you're paying way too much in payroll. So having that insight into gross profit margin is super critical, and people don't really see that. And that kind of stems from, just beginning, setting up your QuickBooks, laying out the chart of accounts, right? And starting to get into the rhythm of how you're coding all of your expenses and transactions. So some people, even in their industry, it gets a little bit, muddied waters, how you want to reflect your gross profit margin, what should hit there and what should hit SG&A. There's a couple different ways to skin that cat, usually across different industries. It's really owner specific, but at least having a finger on that pulse is going to be super important for a business to understand how to scale and what their human capital capacity is, and how much is going towards it. So big, important thing to do there. If you see 100% gross profit margin every month, you're already right out. And then a quick temp check on if you're doing it right. Look at your gross profit margin as an average for a trailing 12 months and just benchmark that against your industry. That'll be the easiest way to see if you're doing it right. We lean on, AI softwares here a ton. Just a simple asking ChatGPT, hey, what should go in this based on what my business model is? And I can spit it out pretty easily. Pretty easy fix for business owners, unless there's, a cleanup component that comes with it. Because when things get muddied, it's hard to unmuddy them. If you have a general account that you've been putting all of your payroll into, and, some of your payrolls in there, some of your admins in there, breaking that out is going to be super critical, and it becomes a lengthy process, right? Depending on how long you've been in business, how big your business is, how fast you're scaling, all the things.
Yeah, and just a simple way to put it too, because I realize some people watching this might not be super savvy on the finance side of things. A good way to think of your cost of goods, your cost of services is whatever is the direct cost that you incur to deliver your product or service. So an easy example is if you own like a video editing agency, the payment that you make to the contractor that edits your client's videos, to me, that would be a cost of service because you have to make that payment to provide that service. Or if you sell shampoo, your cost of goods would be the shampoo bottle, the pump, the chemicals to make the shampoo. And if you build fences, your cost of goods would be buying the wood to build the fence. So basically, if you're not able to see your cost of goods or cost of services, you're not able to see how much it's costing you to deliver the service. And if you can't see that, it's really hard to improve it. Right. So that's why that's really important. And we could probably talk a whole hour about that one, but
Yeah.
that's one of the first things that we look at. The next one is what Devon likes to call Sally's. You want to talk about that real quick?
Yeah. So typically when I start this audit process, I run a trailing 12 month by month P&L and balance sheet. And just an easy, gut check on your balance sheet is if you see stagnation, month over month, numbers aren't changing, something's not right. Or you have an accounting team that's kind of doing lump entries either quarterly or annually, whether that's on your assets, your car payments, there's no amortization going on. You have credit cards that are just staying the same every month, or they're negative. Something's usually fishy when we see stagnation month over month. And what that's doing is just, once again, inhibiting you from making decisions based on the books, right? You might think that you're in a great cash position or a great liability position when you're really not. You're running current ratios that are never changing month over month. So it's really hard to understand what's going on in the business, the health of the business. And what it does is it also hurts you on the backside, right? If you're preparing for exit, private equity firms, chew this up and spit it out. And also it's going to hurt the valuation when they see that this hasn't been, kept up with, or they're not seeing a progression in the right direction of you knocking out your debts and increasing your assets and just strengthening the company. So there's a couple different things that can really go south pretty quickly when we see that stagnation.
Yeah, and we typically see this a lot of the time when the client's accounting solution is just an end of year tax CPA, where the tax CPA basically gets their hands on it, once per year in January or February, and they go through and make a bunch of adjusting entries to try and make the balance sheet make it at least a little bit of sense, and then it sits without being touched for a whole year again. And going through that whole year of having it be, stagnant, like Devon said, it really just muddies the water, and really can be misleading on your actual financial position. And, that route can be okay, when you're under a couple 100,000 a year in revenue, you're doing 200, 300K a year. Like, sure, it's not the biggest deal in the world, but as you start getting past 500K, and especially when you start getting past $1 million, just not having an up-to-date balance sheet really is not it.
I think that I kind of disagree on that. I actually think that it's more critical for startups because they're the most, cash strained companies. They need to understand where they're at. They're usually taking out debts. It's like, how much am I paying, in interest on this? Is this the best option? Should I have a line of credit? Should I be leaning on credit cards? Should I look at something like factoring? I actually think that those startups really need to have more of a focus on this than even your bigger companies, because yes, they might have more runway to take care of it, but really scaling up to that 500,000, 1 million mark, it's really critical, right? Those new business owners getting started up, they really should have, a finger on that pulse intensely because it could go so quickly. Yes, your expenses are lower, but you're usually leaning on some sort of cash mechanism to get you to the next month to cover payroll, whatever it is. So getting this cleaned up to them, I'm sure would help them sleep better at night.
Well, and oftentimes you end up paying more in taxes than you need to because certain things aren't being added to the balance sheet, like the interest expense, different things like that on different loans, right? So yeah, very, very important one. This is you can very quickly see the financial health if you go run a trailing 12 month, like Devon said, and look and see, okay, month over month, is there multiple balances that are the same? They likely should not be that way. And the next one goes hand in hand. It's very similar, right? Having a negative cash or liability accounts on the balance sheet. And this usually just points to accounting errors, right? Like there's certain things that in the accounting finance world really should never be negative, right? So yeah, what do you think here?
I think that just, AR showing negative values first, big red flag for GAAP in general. But also it's just signaling bad journal entries, system misuse, lack of a closing process. And it really undermines the credibility, once again, with investors, lenders, the IRS. Going to open you up to some audit risk, which we hate. Last thing we want to do is give them any red flags of just showing that, we're not competent in the books, or we have an accountant that lets things slide. So just things that really shouldn't sit this way are easy, low-hanging fruits for us in the audit process, but then also for the IRS to really make a good rationale or point as to why you should be audited. It's just the easy things that can be sniped from a million miles away. So if you see these things, go in, look at your processes, understand why it's going that way, because it's usually one of those issues.
Yeah, and like we said a little bit in the earlier one, it can really skew the ratios and really the financial position, right? If you have negative accounts receivable and you have negative, payroll liability accounts and all these different things, it can really, anytime you try to do any sort of analysis, if you have someone help, it's not going to be true if you have messed up balance sheets. And the next one is DSO and DPO. I also know this is one of Devon's favorites. This is, what's the D?
Days sales outstanding and days payable outstanding. So
Yes.
basically how quickly you are paying your bills and how quickly you are getting paid. And a lot of times there's a lot of cash sitting in there, right? And people don't even know what this KPI stands for. So days sales outstanding, right? How quickly are you getting money in from your customers? And it's a fairly simple, KPI to run. It's an easy ratio. But, if your clients aren't paying on their terms, or your customers aren't paying immediately, like you're in some sort of the clothing business, right? Where it's just cash on delivery, you're basically acting as a bank. So when DSO starts slipping away and you start seeing 60, 90 days, you need to really look at terms. You're not a bank. You're not in the business of banking unless you are, but usually you're not in the business of banking, and you should be making interest on that because you're essentially loaning out money to your clients.
Yeah.
So really tightening those controls, getting contracts in place, getting some prepayments in, it alleviates some cash constraints on one side. And then on the flip side, you want to sit on the other side of the table when you're paying your bills, even though, accountants are great at what they do. They like lists, they like to check things off. That's a great thing, right? Not necessarily. If I have net 30 terms and my accountant is paying them within 1 week, that's 3 weeks of that cash flow that we could have utilized elsewhere. That would have brought us money back in. So paying bills, while it is nice to have, peace of mind to know that the box is checked, I would argue that it's best to set up that auto payment to go out on the day that it's due, or at least it hits their bank on the day that it's due, just because a month of cash is still a month of cash and it's much better in your hands than it is, your vendors. And then always going back and going for longer terms. The longer that you can keep the cash, the better. Cash is still king.
And this is the first place we look when a client is like, hey, there's cash flow issues. Like, we're having a hard time with cash in the bank. It's like, okay, this is the first place we can look. I mean, it's usually one of the biggest levers we can pull, right? How do we collect cash sooner and more of it? And how do we pay bills later, less of it? Is really what we're looking at here. And it kind of goes back to the health of the balance sheet, right? Because if you have not accurate accounts receivable and accounts payable data on the balance sheet, then there's no way to run these KPIs to actually see what your sales outstanding and payables outstanding are. So again, that's why having the financial health on the balance sheet and the P&L allows you to look at something like this, which then it's like, okay, this is a clear lever we need to pull. We need to incentivize clients to pay us sooner so that we have more cash. We have a few vendors that we've been working with for a long time. Let's see if we can push from net 30 terms to net 40 or net 45, net 60, whatever it is. And all of a sudden, after 30 or 60 day period, your cash position can change quite drastically just by pulling a few of those levers.
For sure.
All right. Next one is your primary revenue streams not broken out. So sometimes in certain business models, it's okay to have everything hit like one revenue account. If you're selling one product, one service, we don't really need to see visibility into the different revenue streams. But there's a lot of people out there that have maybe 3 products or 3 offers that, or there are 3, primary things that they sell, but then all of the income hits one account, where then it becomes really hard to see which of these 3 is most profitable. What we see a lot of the times is, say that someone is selling, service A and service B, and service A takes way more effort and energy, way more logistical intensity, and has less profit. And then over here, they kind of neglect this one, but this one is way easier to fulfill and is way more profitable. It's like, well, maybe we should spend more of our time and effort and money on B instead of A. So by breaking out the primary revenue streams and helping get some more insight on the different things that you're selling can also be a pretty big lever. Because oftentimes, it's not that business owners aren't working hard. I would say most business owners actually work hard. But this is where it comes into like working smart. Like, are we putting time and effort and energy into something that isn't as profitable as maybe something else that we could be putting that time and effort and energy into?
And I always say, well, common term, numbers aren't, everything in your business. They are the only thing. And I stand by that. And this is one of them. right? I think that we see a ton of companies come through with no job, no location level margin tracking, construction clients with, over 10 million in revenue, no job costing, no WIP. It's like, how are you flying so blind? Multi-location businesses with all revenues and expenses lumped together. So yes, the revenue stream, but also the expense side, right? And that matters. That matters a ton because owners right now, they have no idea where money's being made, where money's being lost. They're missing pricing optimization, fraud detection, performance management. All those things really fall into understanding what is going where, coming in and going out, right? I want
Yeah.
to see the margins on both, or
Yeah.
3, 4, 5, however many locations you have, whatever that is. It's really critical because you may be spending a ton thinking that you're expanding into a new geographical location or a new area of business. And in reality, you should have never left. You should have doubled down on what you had because that was much more
Yeah.
profitable than this new endeavor. And yes, there's growing pains, and yes, it takes time to scale and really hit a good stride with new endeavors. But still, after a couple months, sometimes it's better to hit the brakes, reevaluate. But you can't really do that when everything's all jumbled together.
Yeah, this very closely ties into the first one we talked about with the cost of goods and the cost of
Sure.
services not being broken out. They're kind of brother and sister. But really just getting a good idea into what does it cost? How much are we charging? Do we need to charge more? Do we need to double down on this revenue stream versus the other one? Okay, so loans and assets not being properly accounted for. So this is, missing the interest or not being properly depreciated. Again, this closely ties in with the salaries, no same as last year's on the balance sheet. But interest expense needs to be tracked to understand the true loan cost and the true, return on the liability that you've taken out, the true return on the cash that you've taken for the loan. And the proper depreciation also ensures that the tax returns are being done properly. The books are tied out, matching the tax return. And mistakes here can really inflate your profits. It can cause inaccuracy on your tax return, like I just mentioned. And again, it just ties to misrepresenting your actual financial position.
Yeah. And I think, right, like, especially with real estate, cost segregation, depreciation, entity structuring, all those things that just go completely, missed. And it happens often because it's a heavy lift for an accountant, for anybody in finance to really get this in. I mean, it's a heavy lift to go and do the process right and get it buckled in and understand your schedule and make sure that everything's depreciated in a way that's beneficial for you. You want to have a good tax strategist on your side because, to your point, missed tax savings, exposure to IRS audits, or back taxes due, which is even worse. Last thing you want to do is have the IRS be any more of a business partner than what they already are.
Yeah, 100%.
But this is one of the biggest exposure points for that.
Almost every single client that we work with, it starts with a cleanup phase where we're going back and fixing the historical stuff and getting it up to date so that we can move forward. And especially when we get, one of our contractor clients that we love, or home service clients, almost every time one of the first things we're doing is, okay, send all the loan documents for all your trucks and all your equipment because none of it has been properly put in on the accounting and in the books. So this is an important one as well. Okay, large amounts coded to ask my accountant or uncategorized income or expense. Again, this is just a clear sign of poor bookkeeping or lazy bookkeeping or just having an accountant that really hasn't taken the time to understand the business. And these entries really delay the accurate financial analysis because, yeah, even if you do get a monthly P&L, but you have 50K hitting an ask my accountant, it's like, okay, well, is that really that helpful? Like, what is this 50K? Where's this broken out? And it really is just immature accounting practice. I do want to say that no matter who your accounting provider is, there always is going to be some level of ambiguity, right? Like if you spend $1,000 at Amazon, like there's no way for anyone to know what you bought because you could have bought almost literally anything on the planet. So there is always a little bit of context needed, but if you're getting, multiple 5-6 figure dollar amounts in an ask my accountant or an uncategorized income, or people are sending you reports with stuff in that and not asking you for more context, definitely some major red flags.
You're better off not even looking at reports, honestly, because your KPIs will be so skewed from things sitting and ask my accountant or miscellaneous, any of those things. I mean, the KPIs are pretty useless, right? Because all of a sudden, if anything in there belongs in COGS, not only, is the gross profit thrown off, but like by how much, right? It could be very significant.
Yeah.
And it also just inhibits strategic steering of the company. The business is flying blind by using this. And kind of a rule of thumb for us, we don't even reconcile, close the books if things are sitting in uncategorized. Like that is a must do, must get to this, must get the context from the business owner to put it in its right place before we will close the books. And that is, I think, what should be the standard practice in accounting. I don't think that should be something that you use as a holding cell until it's tax time to go through and say, okay, here's what everything was. Because also you forget, right? I don't remember what I had for breakfast yesterday, let alone what I spent in January on God knows what. So staying on top of that, having a team that brings that to your attention. Yes, it can get annoying, but still, expenses happen. It's just put them in the right place. And after a couple months, your accounting team understands how you spend, your kind of spending habits, what you're doing in the business. And maybe it's only 2 transactions down to 1 transaction. And all of a sudden, there is no real question marks anymore because we understand what's going on, or you kind of hit a rhythm in your business where things are steady. But either way, I wouldn't even have that as an account option in my chart of accounts if I could.
100%. Basically, all of these things, what they lead to is uncertainty, really, when you break it down. Right? Flying blind and being uncertain. The next one is bank accounts not being reconciled with your accounting software. Almost every single time that we go in and do an audit, this is the case for more than just the prior month. It goes back further than just the most recent month. So what this means, basically, we want to make sure that what's in your bank account, in your business bank account, actually matches exactly to the dollar what is inside your QuickBooks account or your accounting software. So this is different than categorizing your transactions. Right? Like if you get a deposit for income, a bookkeeper will categorize that to, service revenue, for example. That is different than reconciling. Reconciling is like literally going line by line, making sure the ending balance in your bank account matches the ending balance that's in QuickBooks. And this is important because software breaks, software makes mistakes. Even with these great integrations, transactions are often duplicated, transactions are often omitted. Interest is often left out, checks are left out sometimes, all these different things. So you can't truly close the books without having things reconciled and buttoned in. And we just see this all the time where it's one of the toughest parts about being a business owner without a finance background is because you don't even understand. Like it's hard to know what good bookkeeping, good accounting is compared to bad accounting. But this is kind of a telltale sign. Like if somebody's just categorizing the transactions, but not reconciling, that's a sign of someone that, really isn't doing what they're supposed to be doing, in my opinion.
And the timing of it, right? Yeah, it's great if you can reconcile on the 30th of the month for the previous month. But then again, all my competition just had their books closed. They're making decisions based off of true, real numbers with reconciled books weeks before I am. And that allows them to pivot, right? And get ahead of the competition. It's fierce now in almost every industry, right? There's so much going on. Economics of small businesses is hard already. Last thing you want to do is, go based off of old stagnant numbers or just not have the books reconciled at all. And you could see an updated P&L and that's great. But unless that really ties with what actually happened, it's useless. The other thing I will caveat here is your accounting team can still go in and reconcile, but you could have a beginning balance that's off, right? So right when you go in your books, you could see beginning balance off by a negative, positive 100,000, and it'll still let you reconcile and it'll just give you an error every month. So I would always cross check and make sure that your beginning balances are tied, because that means that every month after that is going to flow the same way. But once you have, a foundational issue like a beginning balance being thrown off, it's very easy to let that number fluctuate every month, even with a reconciliation, because that number is just going to go up or go down and it's still not going to be 100% accurate. So somewhere in the books, something's not right. Yeah. You really won't know what or when that was. So that's another caveat, getting it done on time and getting it done right.
Yeah, and there's a lot of folks that we talk to that are like, yeah, my books are actually in great shape. Like they're perfect. I feel really good about them. And we get in there and it's like none of the accounts have been reconciled for months, sometimes over a year. And honestly, the longer that you go with stuff in Ask My Accountant and things aren't categorized and things aren't reconciled, the more errors and discrepancies, they just keep accumulating. And then on your end, it becomes more hard and more costly to fix all of this backward. So catching these early is definitely better than waiting. Okay, so balance sheet and balances, retained earnings and equity specifically. I'll let you go on this one.
Yeah, balance sheets need to balance, right? If there's anything that's awry, it's going to throw, something off, and you're going to have some sort of discrepancy between your assets and your liabilities. Retained earnings equity, some people just use that as a bank account, essentially, if they don't want to take out their own salary. People are just pulling draws, and all of a sudden you have negative equity or negative retained earnings, whatever that is, depending on how it's being coded, it just looks funky and it looks like something sketchy is going on. The IRS doesn't like it. We don't like it. But having those negative balances or not taking out, a proper salary for yourself as an S corp, big red flag for the IRS, big audit exposure. So all of those things could really throw off your balance sheet. It's kind of a delicate balance in terms of how you're doing things. But once again, if you're educated, you know what you're doing. It's an easy fix. But a lot of business owners aren't in business and finance. So it's okay to not know, but that's also why it should be something that you're outsourcing or having a trusted provider to go in and ensure that your balance sheet is at least balancing.
100%. Another one that we see a lot, we see all of these a lot, to be honest, but just payroll accounts not being properly accounted for. So there's a lot of people that don't properly break out the payroll, don't properly have it hitting the right tax accounts. So what we see oftentimes is negative payroll liability accounts, the federal, state, FUTA, Medicare, Social Security taxes not being broken out properly. And then if you have benefits or 401k, that type of stuff, oftentimes that's not being broken out properly and everything's just getting lumped in again, really limiting the insight. And negative payroll liability accounts, that often means that there's been missed payments or there's been misclassifications, again, signaling, not competent accounting practices. And proper accounting avoids penalties and ensures employee trust too, right? Payroll is one of those areas where very high audit risk if you're fucking up your payroll and your payroll, accounts, and often heavy fees as well from the states. If you're not properly withholding and paying the different payroll taxes that need to be paid timely. So this is a really important one. And oftentimes as well, what we also see, if you're an S Corp owner, but you have other employees too, a lot of times people will bulk in your S Corp salary with your employees' wages, which then again skews a lot of those KPIs around, your payroll costs compared to revenue and things like that. Because your S Corp salary really should be its own account called officers compensation, and not being lumped into what you're paying your employees. So this is definitely a big one. Anytime we see a negative payroll liability account, we're just like, oh man, what's going on? So anything here, Devon?
You nailed it. Yeah. I think that it comes back to a process, and competence kind of thing. Just got to go in, do it right, and ensure that you're not exposing yourself anywhere.
Mm-hmm. Yeah, another thing too is like if you're using like Gusto, ADP, Paychex, like any of those types of things, and your bookkeeper or accountant doesn't have some sort of access, or you're not sending them some sort of reports, pretty good chance things aren't being broken out exactly as they should be in the accounting. Categorization inconsistency. Since I railroaded the last one, you can do this one.
Okay. Yeah. So, every month you have meals, but you have 3 accounts, and one is team meals, one is owner's meals, and one is just meals. And all of a sudden, every month you kind of forget what you coded the last one to. And before you know it, everything is lumpy and it looks like you have really high, just regular meals this month and really high employee meals the next month, or, marketing versus advertising versus travel versus whatever it is. There's a delicate balance in your chart of accounts, and just having them set up right is critical. I know it's kind of the first thing that you do when you open up your business and your books, but it's hard to make sure that it's not too complex, but also not oversimplified. That's why we love parent accounts, child accounts, ensuring that everything kind of rolls up. If you need that granularity in your expenses, understood. But there should definitely be a standardized cadence. There should be rules in place. We want to remove human error from that. If every time that you're going on booking.com, it's, travel, just call it travel. We don't need travel and hotels. Unless you do, then just make hotels. But throwing things in different accounts every month just also muddies the waters, makes it harder to understand where everything's going, because it can really skew, if you're tracking expenses as a percentage of revenue, one month meals is really high and then the next month it's travel. But if it's really a problem, I need to see that issue happening in the same account month over month for a CFO to be able to flag that and do something about it. But if it just changes and it's not a consistent issue because of the categorization, it becomes a little bit harder to see. And what we want is simplicity. We want it to be concise. We want, the owner's times to be, not taken advantage of. So I'd rather have a 5-minute conversation than a 20-minute conversation digging around and trying to figure out where something was coded. So rules are a beautiful thing so that there is that consistency and just standardized cadence.
Yeah, we see a lot getting thrown back and forth between software expense and advertising expense. Like a charge for a Facebook ad will go into Facebook ads, and then one day it'll go into software, things like that. It makes it inconsistent, right? There's no way to truly do benchmarking or to truly see, okay, did it go up? Did it go down? Because if you're flip-flopping it, it's all bad. So doing it consistently will create clean and reliable financial reports. Contractors not being categorized correctly, basically, not collecting, the W-9s, not collecting, and filing 1099s. Contractors that are cost of services or cost of goods being put in operating expenses, again, kind of ties back to the very first one we talked about. Just really need these broken out correctly. And from a tax perspective, making sure the 1099s are being filed and you're collecting the paperwork that you need to. Increasing accounts receivable, it's not being recognized correctly. Increasing accounts payable, not recognizing expenses correctly. Oftentimes, this is like accrual-based type stuff where things are just not being recognized and shifted from one way to the other timely and as they're supposed to, which again makes it basically impossible to do any cash flow forecasting or profitability analysis when things like this are so heavily skewed.
Right. Sometimes we see AP kind of as a plug for cash-based expenses. Same thing if you're looking at trend lines, and I love looking month over month because it gets you somewhat like context into the process of what's going on in the books, right? If I see AP every month going up, either you're in a severe cash crunch and you can't make your bills, or, and this is usually what it is, you're just kind of using that as cash-based expenses. So instead of just categorizing everything, it's sitting in AP and it's just growing and growing. And once again, as you go to investors, as you have, different banks looking at you for lines of credit opportunities, they see this big looming liability that's not reality. So it's inhibiting the clarity of the business, your cash position, profitability, and then also probably going to inhibit you from any sort of like investor relations that you might want to go after.
Yep. And it ties in with this next one, just unexplained fluctuations or inconsistencies. Oftentimes this can be fraud risk if you have really, really crazy swings, or, there's an account on your chart of accounts that has never been there. And then all of a sudden there's a big charge there when there never has been, different things like that. And again, it's similar with this, your inventory is building up, but the sales aren't growing. It's like, okay, inventory is probably not being adjusted, all this crazy stuff.
And just softwares, right? All the integrations now with QuickBooks, as you're, allowing your softwares to talk to each other, you need to understand what's going on the backside of that with the QuickBooks. If you want to have one source of truth for your financial data, you need to ensure that you have a team that's competent in softwares and updated with, what happens when all of these transactions flow into your books. Where is it going? Who's mapping the accounts? Because that can go sideways really quickly, especially for bigger businesses. All of a sudden you get a lump transaction of 3 million in inventory. Whereas, you may have just purchased that, but that's going to come in over the next 6 months. And all of a sudden your balance sheet is, already accounting that 3 million and now it's showing 6. So a lot of things can go sideways just with software. It's a great thing to have. I love software if it's, used properly and if it's reconciled properly and there's a good process in place.
Mm-hmm. And the last one is just inconsistent communication with the accountant. It's like oftentimes we get on calls and people are like, well, you said this thing, and then the next time you said this thing, or he explained it for 30 minutes, but I left and still had no idea what it meant. So I'm still just as blind as I was prior. Or maybe you only talk to them once per year. Again, if things are only being adjusted and talked about once per year, you're basically flying blind for 11 months. And it's kind of like, okay, how can we expect to improve on some of these financial metrics if we aren't tracking them? They're not accurate. We're not looking at it more than once per year. It's just not a super realistic outcome for the vast majority of individuals. So having proactive financial management rather than reactive, really will keep you out of a lot of trouble. So this has been a ton of fun. You go ahead. You got one more quick comment?
No, I was just going to say there's usually a direct correlation with the time that it takes 100%. For accountants to respond to the business owners and how clean their books are, right? If you're not hearing from your accountant for a week, I would say your books are probably 50% all right. If you're not hearing for a month, they're probably in really bad shape. And even longer than that, forget it, right? Like that communication piece is so critical and it's kind of foundation to everything else. And it's a direct correlation from what we hear, right? We hear all the pain points. We hear, hey, I'm not hearing from my accountant. It's like, well, how long has it been? And then as soon as you look at the books, it's like, wow, it certainly has. So direct correlation there.
100%. And honestly, this could be like a 2-hour video. We could talk way more in depth on some of these. And there's honestly like another 10 that we didn't even put on here. But this has been super fun chatting about it. Devon, thanks for jumping on and sharing some of your expertise with everybody. I mean, if you guys would like us to uncover some of the red flags that's in your business financials, and as well as craft a plan together on how to solve them, you can book a call down below. I'll have the link to this Gamma doc in the description of the video. So feel free to go here, use this. You can book a call. And if it's a good fit, Devon will jump jump into QuickBooks and we'll prepare an audit for you and go over, the red flags that are affecting you and your business, as well as how we can fix them and what working together would look like. So thanks a bunch. See you on the next one.